In 2006, Warren Buffett placed a bet. He bet anyone $500,000 that over 10 years, an S&P index fund would outperform a collection of hedge funds. The reason for the bet? To prove a point. As Buffett said in his annual Berkshire Hathaway report, "Over the years, I've often been asked for investment advice, and in the process of answering, I've learned a good deal about human behavior. My regular recommendation has been a low-cost S&P 500 index fund. To their credit, my friends who possess only modest means have usually followed my suggestion. I believe, however, that none of the mega-rich individuals, institutions, or pension funds has followed that same advice when I've given it to them. Instead, these investors politely thank me for my thoughts and depart to listen to the siren song of a high-fee manager, or, in the case of many institutions, to seek out another breed of hyper-helper called a consultant." It wasn't until a year later in 2007 when investor Ted Seeds took that bet. Warren Buffett selected a low-cost Vanguard index fund, and Ted selected 5 fund of funds. Ted actually got an early lead in the first year. Both were down significantly, but Buffett was down 37%, whereas Ted was only down 23.9% across the funds. However, things changed over the subsequent 9 years, and Buffett ended up winning by a landslide. His simple Vanguard index fund returned 7.1% compounded annually compared to Ted's actively managed hedge funds, which returned only 2.2% after fees. Buffett's response to the win was both true and disheartening. He said, "Human behavior won't change. Wealthy individuals, pension funds, endowments, and the like will continue to feel they deserve something extra in investment advice. Those advisors who cleverly play to this expectation will get very rich. This year, the magic potion may be hedge funds, next year, something else. The likely result from this parade of promises is predicted in an adage. When a person with money meets a person with experience, the one with experience ends up with the money, and the one with money leaves with experience." And I've been thinking about this a lot. One of the reasons I created this channel is to try to convince you that the best investment strategy is to dollar cost average into a low-cost broad market index fund and hold it for many, many years, so you can experience the magic of compound interest. Yet, if Warren Buffett can't convince you of this, what hope do I have? But I do know that you could convince yourself, just like I convinced myself many years ago. Here is how. The next time you're about to buy a stock, write down exactly why you think it's undervalued, and make sure the reasoning is measurable. For example, the current price of Alphabet stock is $99 per share. Let's say you believe the intrinsic value is $130 per share. Ad revenue will grow at 10% year over year. Search ad earnings are more robust than the market estimates, and fears about ChatGPT are overblown. More creators will move from TikTok to YouTube as YouTube implements better ways for creators to monetize their content, resulting in a 5% year over year increase in YouTube ad revenue. Now, this is not necessarily something I actually believe, but it's just to serve it as an example where you've calculated what you believe the intrinsic value to be. You've quantified how much earnings will grow and why it'll grow, and you are being somewhat contrarian in your beliefs, which is essential because stocks are forward-looking, so you're saying it'll perform better than what the market expects. For calculating intrinsic value, I'd recommend reading The Intelligent Investor by Benjamin Graham. As news comes out, you can evaluate it against your beliefs. Do this long enough, and there is about a 99% chance you'll realize that even when the stock does go up, it's not for the reasons you expected. In other words, you just got lucky. If that's not the case, and you consistently beat the market and correctly value companies for many years, then wow, congratulations. Maybe you are the next Warren Buffett. But this will likely take years to discover, so you should consider putting a large percentage of the money you set aside for investing, like 80 to 90%, in a low-cost broad market index fund while you run this experiment. And in the end, don't be too hard on yourself. Around 90% of people who spend their lives trying to beat the stock market fail to do so over a 10-year time period, according to the SPIVA scorecard, which tracks this sort of thing. Even the legendary Warren Buffett has struggled recently. Returns of Buffett's Berkshire Hathaway just barely beat the S&P 500 by less than 3% total over the last 5 years. Even people who made a lot of money probably just got lucky. For example, 10 years ago, I bought some Bitcoin. Now, it's not a stock, but it was still an investment. Some people thought I was smart for getting in early, but here's the secret. I just got lucky. I bought it thinking the price would go up because real-world usage would increase dramatically. Little did I know it would go up because I still don't really know why. People compare it to gold, limited supply, FOMO, whatever. Point is, I was just lucky. And you'll get lucky a few times too, but try not to confuse luck with skill. Be honest with yourself. So I hope you found this helpful. Please hit the subscribe button if you want more videos like this, and have a wonderful rest of your day.